the thing I like about triple nets is once you do your due diligence, once you close, you create this relationship with the tenant. You've just got a monthly check coming in, or wire now. But there's a ton of front end work. But once you own the property, the time, the management piece is very, very minimal.
Yeah. Welcome to this week's episode of the Keeping It Real Estate Show. I'm your co-host, Dan Breezy, and today we have the pleasure of having one of my really good friends, Kyle Schlangen, on with us. Kyle has invested in several multifamily deals with us over the years, and he has done over 25 triple net lease deals on his own. So in this episode, we're going to dive into all things triple net to help educate you on why we'd like to do a few of these deals every year along with our multifamily deals. And just to make sure this is clear, our main focus at Granite Towers is still multifamily value add deals, and we have had some demand and interest from our investors who want triple net deals for the cash flow and depreciation. So these triple net lease deals are nothing like the multifamily deals as far as operation and time goes. We're not putting nearly as much time in these deals, and we're going to dig into some of that right now. So Kyle, welcome to the show.
Thanks for having me, Dan. Excited to be here.
Yeah, gosh, so we've known each other for a good 10 to 15 years now, and we have many friends of friends in Minnesota, where we're both from, where you're still living, and we've done several deals, and I've really grown to like your conservative investing style, Kyle, and just your consistency in creating strong returns, and I want to brag on you for a little bit. So you've done 25 deals, and we were just chatting a little bit before the call, and you've made money on all 25 deals and have done extremely well on the vast majority of them. And so, Mike and I are not experts in the triple net lease space. We're going to reserve that space for multifamily. So that's why we're working with you, Kyle, on bringing out some high quality deals for our investors. And I just wanted to lay that groundwork for all of you listening right now. You know us for multifamily, and triple net is another asset class that we will be diving into, and it's going to be through the help of working directly with Kyle. And going back to rule number one of investing, it's the people. Who are your partners? Kyle, Mike, and I have very similar core values. We have proven great synergy from our past multifamily deals that we've owned together, the three of us. So just keep that in mind when you guys are building out your teams on your end. So Kyle, let's talk a little bit triple net. What was it, or what is it about triple net that drew you into that asset class in the beginning?
As I mentioned in a previous podcast I was on with Mike Roeder, your partner, we delved into this a little bit, and it kind of started in about 2013, 2014. I owned an auto repair business, and I was really looking for something that wasn't so hands-on, something where I needed to get passive income. And I looked at some multifamily investing, but a lot of the properties I was looking at were far too large for me to handle personally. I wasn't very familiar with the syndication aspect, and I really found triple net leases to be something I could handle personally. It didn't take a ton of my time, and it was really just a great net worth builder as well as a great cash flow play. So I've been doing this now just about 10 years, and knock on wood, it's been a really solid business for us that I hope to do for the next 20 to 30.
Yeah, I love that. So how did you become educated enough to buy your first one or two deals? I mean, did you just start diving in and going for it, or how did you figure out what to do?
When I'd get home from work, it was really looking at get our kids to bed and then just start researching, how do I make passive income? What's the best area to look at? And again, I looked at multifamily, I looked at retail, looked at office space, and I found this triple net deal, and I really wasn't familiar with it at all. So I just became a maniac about diving in and learning and education, and listen to every podcast you could do, all the folks who have done it before me, and just kind of really took a lot of different pieces of some experts' models and really turned it into, a business that I could work around my schedule, and that could build kind of a life that my wife and I and our kids were really looking to have.
That's awesome. So what was the first deal you guys bought? Do you remember what it was called, or what the brand was?
So the first one was an Arby's, but I mean, it took about 2.5 years of me just educating myself, getting analysis paralysis, looking at everything before I finally pulled the trigger on something. And it was actually an Arby's here in Minnesota. And there was just a private gentleman selling it. There was no broker involved. So we actually worked directly through the process together. And he owns, I think, a dozen or more. So he actually really educated me on how to get through the process, how to get financing on it, how to close on it, how to really make that relationship with Arby's, a pretty large tenant, make that a good long-term success. So I owned that property actually for about 5 years before selling it. But during the ownership of that time, I also had built up some capital and really wanted to start investing. So I got into, a handful of other tenants, but Arby's was really the one that started us off.
Yeah. And so you have a kind of a unique perspective where you've got a lot of experience in triple net, and you had some serious experience in multifamily. And we owned a deal, the three of us, in Minnesota, and another one, and you've invested passively in these deals. What's the main difference of being a general partner or an investor in a multifamily deal versus an investor in a triple net lease deal?
Honestly, the time and the management is the big thing that I appreciate it with multifamily. It's just far more time consuming. You've got, in our Minnesota property, we had 84 different tenants, and I was there probably 4 or 5 days a week cleaning up garbage and working with tenants. And it was hands-on. It was a lot of work, and it was fun work, but it's very hard to scale when you're spending that much time at one property. And the thing I like about triple nets is once you do your due diligence, once you close, you create this relationship with the tenant. You've just got a monthly check coming in, or wire now. But there's a ton of front end work. But once you own the property, the time, the management piece is very, very minimal.
Yeah. I mean, and you guys, I can attest to that. I mean, Kyle would be calling us, and he would be there on site, cleaning up the parking lots, knocking on doors sometimes because this, resident profile wasn't the most efficient at paying rent. And, he got some firsthand on-site work done. So I can appreciate that. And so with your triple net deals, once you close on the deal, how much time and effort are you putting into the deal on a monthly basis about?
It really varies deal to deal, depending on if it's a double net, triple net. So what we're looking at is mostly triple net deals here. And, we should go back and what a triple net deal is. What it means, it's net, net, net. So we do this, one, to minimize the time, and two, to minimize the risk. So what it means is the tenant is on the hook for paying rent, for maintaining the property, for paying taxes on the property, for paying insurance on the property. So really, in a well-done triple net deal, I'm spending 2 to 5 hours a month probably on it, max. If there's ever questions that come in, regarding a maintenance issue, they need my permission. I'll still go there quarterly if it's close, or if it's local. I'll try to go once a week just to oversee the property, but they're really not anything I would have to do.
Got it. So 2 to 5 hours a month, and that's a triple net deal. And what would be a double net deal? Like, what's the difference between triple net and double net?
So double net has some different structures where tenant will still pay rent. They'll still pay taxes, insurance, but myself as the owner, I'm on the hook for some roof and structure things. So it's very important when I go through and purchase one that I'm going through with contractors and looking at the condition of the building, condition of the roof, condition of the parking lot, and just ensuring that if maintenance issues are to come up down the road, that may take some of my time. But for the most part, we've been fortunate and done our due diligence well enough on properties where I haven't had a whole ton of maintenance time that we've had to put into them.
Yeah, so you got the double net. So you're on the hook for roof and structure. Have you done several double net deals?
I have done several double net deals because they can yield a little more typically, but there is a little bit more risk with them. But they're also with some pretty major tenants in which I trust their credit very well. So for me, it's well worth it. And just looking at the condition of the building, going through it with contractors, ensuring we're in a good spot, I really mitigate our risk that way.
Yeah. So how are you finding these deals? Let's go a little bit in the beginning. You've transitioned from your previous career. You do all your education. You're starting to buy this deal. You found the first one from a private owner. Now, how are you finding the deals?
It's a lot like multifamily, to be honest with you. Once you source one deal, you buy one, you buy two of them maybe. And, I started out with looking at LoopNet and Crexy and just seeing what everybody else is seeing on the retail side. But now that I've been in it long enough, I've got brokers who call me pretty regularly. I probably get 4 to 5 broker calls a day from, some are new brokers, some are ones we've done other deals with, but I'm finding a lot of stuff off market that they're bringing to us that they'll, whether it's a distress sale or it's something that's, before it's even coming to market, an owner just wants to get a deal done without the hassle of listing it. It's kind of an unfair game. And I've kind of heard that with multifamily as well. As soon as you start closing some deals and you make a track record or you can prove yourself, brokers want to come to you with deals because they know you can get the job done. So I've been fortunate enough to have, a few specific brokers we work with around the country, but probably 20 of them who call pretty regularly who are helping me source deals that a lot of the general public just won't see.
Wow. So there you go, you guys. So and what Kyle's talking about, I can say with certainty, that's exactly how it was in multifamily in the beginning. Difficult to get in your first one or two. Who are you? Can you close? After you do a couple deals, very easy to get other deals. And it is a very unfair game. In the beginning, if you don't have net worth, liquidity, and reputation, it's almost impossible to buy a deal. It's very difficult. Where if you can partner with somebody, or if you have a good chunk of cash and you're persistent, they maybe throw you a bone and see how you do. And so that's one of the reasons, when we're coming into the triple net space like we are right now, instead of us going and doing all the groundwork and building these relationships, it's more efficient for us to work with somebody who's an expert in the field. And that's where the synergy with Kyle and Granite Towers comes into play for us, is we don't have to go do the groundwork and build these relationships. And, we're not going to see the same deals Kyle's looking at. And Kyle, one thing we've talked about in the past, I think that stood out to me is, we look at a lot of deals in multifamily, but you look at a ton of deals in the triple net lease space. Remind me, how many deals are you looking at a month?
Well, keep in mind, triple net deals are so much easier to underwrite. When I've got a relationship, especially with a tenant, I keep going back. It's kind of a boring game because I try to work with the same tenant over and over and over. When you guys are going into a multifamily deal, you're having to do a ton of underwriting on each deal and on each market. Mine is partially market based, but a lot of it is tenant based. So, it varies during our busy season. When our kids are back in school, I'll look at significantly more, but I'll probably look at 50 to 100 a day, and I can underwrite, 10 to 15 of those. I've got a good enough eye by looking at them by now, saying what I don't want to waste our time on, but I'll probably underwrite 10 to 15 a day. And of that, I'll try to close on, one a month, one every 2 months, something like that. That's just a comfortable rate for me, I guess.
Oh, so you got 50 to 100 a day, and then 10 to 15 you'll underwrite. And again, I'm glad you emphasize the efficiency of underwriting the deals, because it's almost seems too good to be true. When he sends us a spreadsheet that he's underwritten the deals, I'm like, this is too easy. What are we missing here? And that's the beauty of triple net. So, one thing that I know a lot of investors have seen over the last, call it 5 years, or really the last 2.5 years, is that some of these multifamily deals, with the bridge debts or with the challenged economy, the cash flow, is needing to be held in order to keep reserves up, to keep the asset in a stable place. Whereas with the triple net deals, have you ever had a deal that has not cash flowed or has not paid what you expected to pay throughout your 25 deals you've done?
Again, knock on wood, we've been very fortunate and underwritten these very hard and very conservatively. So, there are some that haven't performed to what I hoped, but knock on wood, I still have not lost any money on them. And again, that's just complete due diligence, knowing your tenant, knowing your market. All of them, we've been very fortunate. We've made money. We've outdone our projections, probably 60 to 70% of them. And probably 30% we've hit our projections. And then I can think of 2 in particular where I wasn't getting rich on. We made money, we got out, and that was right in that, early 2022 when interest rates really started increasing heavily. And I was still able to get out of them profitably. But again, it's just the amount of due diligence we do on it is knock on wood, proven to be pretty successful.
Yeah, that's huge. So a lot of the investors that are coming to us are looking for very consistent cash flow, and they're looking for larger depreciation write-offs. So Some of the stuff we've been looking at recently are car washes, and a lot of folks know the car wash game, there can be some very large write-offs. So if you can mix a really nice depreciation loss with some cash flow that's very consistent, ideally in that 5 to 6% range, and it's not guaranteed, but it's as close, seems like, as you're going to get with real estate investment, to having cash on cash coming in the door. And then ideally, because of where we are in the market cycle, with rates rising so much and cap rates following, that, you know, over the next 3 to 5 years, you're going to see some compression there and get a little bump on the end. That's kind of like the icing on the cake in our eyes. Did I describe that right? Is that how you see these deals and the value in what you're looking to create?
I think you're absolutely right, Dan, but I think we should just take a quick step back. And so, as you guys know better than I do in multifamily, you know, with the 2017 Tax Cuts and Jobs Act, you know, we saw some major depreciation advantages we've been able to take advantage of, you know, and that is starting to sunset. I think it sunsets in 2026. But there's still some really good bonus depreciation you can take out there, especially on a certain asset class. And that asset class right now is anything oil related, fuel related. So you've got convenience stores, quick lube, and car washes are also in the same category as those, if you will. So we're still able to take some pretty significant bonus depreciation that you can't find in multifamily. So if we can find cash flow as well as take advantage of that bonus depreciation, it's really a great time. And you hit the nail on the head when you said we're buying at cap rates that we haven't seen for the last 5 years on this. And as these interest rates sneak down, as we all expect that they will, I think we'll see some cap rate compression. We'll see some people obviously be able to buy better with better interest rates. So that really is the icing on the cake.
Yeah. That's where we're coming in. So, and the deals we're looking at placing 5-year debt. You know, it is recourse debt that the general partners take all the risk on, but it's something where the exit on these loans isn't a super stiff prepayment penalty. Like a lot of the stuff you see with Fannie and Freddie, there's some bonuses of Fannie and Freddie for sure. You got the non-recourse debt, you got 30-year amortization, you got interest only. Whereas with these recourse loans coming from regional banks, you maybe have a 20 to 25-year am. Interest rate's going to be higher. You might not get any IO, but your prepayment penalty is very slim if you're wanting to exit. Did I hit that right, Kyle?
You're right on. And with the number of deals that I've done, we can kind of carve out some different cool things with each loan. So if we want to try to push for 25 to 30-year AMs, there are some banks that will allow that. They'll get more aggressive on interest rates than, especially a lot of these local regional banks will get very aggressive on interest rates for local deals. Typically, every deal I'm doing is 0 prepayment penalty, as long as we are selling the deal and not refining it. And with a refi, normally they're pretty easygoing about not having a large fee at all to refi if rates do come down significantly. So that's kind of the beauty of working with somebody locally versus a Fannie or Freddie, is it's much more based on a personal relationship that they're likely to do what works for you because they want to continue to do deals with you.
Yeah. So for our listeners, let's just say they're looking at potentially investing in their first triple net lease deal. What would you be looking at, Kyle? What are your checks and balances to say, yeah, this is something I'd invest in, and here's why? What are some of the, the no-goes?
I've heard it on a bunch of multifamily podcasts as well. We don't invest in the ghetto. We steer clear of that. We stay to typically pretty suburban markets. Stick with a handful of tenants that I'm very familiar with, have had relationships with, done previous deals with, that I'm very comfortable with. Not to say we won't venture into new tenants, but it's just going to take a considerable amount of more due diligence. Have to make sure, obviously, our lender is on board with financing to these tenants. Have to make their financials look good. I mean, there's a lot of DD, again, that we do to ensure that these investments are not going to go haywire. And then, more importantly, on a return side, as I'm sure a lot of your investors are looking for, is I want major depreciation and I want consistent cash flow. Anything we can make on the back end to, increase value, whether it's annual increases and getting some cap rate compression, like you said, that's all icing on the cake. But really consistent cash flow as well as depreciation is, what any really solid long-term investor is looking for.
Yeah, good stuff. With the DD piece you talked about, the due diligence, really, it's just like in multifamily. You got two parts. You got the physical inspection, do you have to do a physical inspection of each asset when it's a triple net lease deal? And what does that look like? And then on the other end, you got the lease and the financials to dig into. Is there anything else that we should talk about due diligence there that should be known about?
I know a lot of investors who don't actually do physical due diligence on triple net stuff. I'm far too conservative for that. So any purchase or any property I purchase, I'm flying out there. I'm spending it a day looking at the property, looking at the market, looking at the housing around it, the amount of multifamily, the other retail, just whatever it may be that fits for that property. I like to get a really good idea of what things look like. I like to meet the manager of whatever that retail business is typically and develop a relationship with them so they can call me on anything. I'd like to get an idea of, I have to know what the sales are, what kind of profitability, each store is at. It just gives me really a sense of calm when purchasing these things that, there's not going to be any fires to put out. And with a triple net, there typically isn't anyway, but just really checking and double checking to ensure that our investment's safe is really, really the goal.
Yeah. And the lease negotiation piece, that's done mainly between you and the legal team and their legal team, or how does that unfold generally?
Every deal is different. So some of these car washes that I've been looking at, and I've purchased one in Las Vegas last year, and it was a little smaller operator, but I was very comfortable with that because of their financials, because of the location. A lot of, we're looking at one, Mr. Car Wash right now. They're a huge entity. They've got their own legal team. So this is a sale leaseback, it's called. So what it means is Mr. Car Wash actually developed the property on their own. And now they're going to sell off the real estate piece and continue to operate the business. And that's what a lot of companies do with their real estate, just because it's such an expensive thing for them to hold. So yes, we are going to have our legal team as well as Mr. Car Wash's legal team go back and forth to get the lease exactly to how we like it read. And of course, we're going to work with our tenant to make it work on both ends. But a lot of stuff we're doing is not sale leasebacks. It's just there's a lease already in place. I have to do due diligence on what that lease already has in place. There's nothing I can change. And then I have to, underwrite it from there to make it make fiscal sense for us.
Yeah. The deals you're buying now, what is the main cap rate you're buying deals at, or what have you seen deals being done at in the last 6 months or so?
The cap rates have certainly come up some, not like interest rates have. And it really varies again, depending on tenant and market. I mean, I've purchased stuff at, sub 6%, like that 5.85, 5.9 stuff. And I've purchased some stuff at like 8.5 caps. It really just varies based on tenant market. The higher cap rate stuff is really a value add play that I'm doing with some tenants that have short-term leases already. And I can do a blend and extend, which is extend the lease term and then turn around and sell or hold or whatever we decide to do.
Yeah, the blend and extend, like just to touch on that a touch. So you close on a deal, and when you close on the deal, you've done a negotiation where the lease will adjust in rent. Is that what is the blend and extend exactly?
Correct. So I've got a relationship with a tenant, and let's just say it's Arby's, for example, and I haven't done one with them in some time, but let's say they've got 1 year remaining on their lease. And for that reason, a seller wants to sell it, maybe isn't tenured in doing lease negotiation or just wants to move into something else, or it's an estate sale or whatever it may be. I will actually work on the front end with Arby's corporate, say, here's what you're currently paying. I know what your sales are. How can we work together to make this from a 1 year to a 10 or 15-year lease? And that might come in to get them to agree to it. I may have to make them a payment. I may have to do something to the building. I'll have to give the tenants something just to show that, yes, I'm here for the long term. I want to work with you. And with that, if they're going to sign a 10 or 15-year deal, all of a sudden that cap rate that I'm purchasing at gets compressed automatically just by going from a 1 to a 10, 15, 20-year deal, whatever it is. Does that make sense?
Yeah, the cap rate gets compressed because it goes down because the value of the lease went up because you have more time.
Correct.
Yeah, understood. So there's a quick example of how you could potentially flip one of these deals. You could buy the deal, set the lease up, have it adjust when you close, and literally 3 to 6 months later, sell. Is that correct?
That is exactly correct.
Got it. Yeah. So that's not exactly where we're at with some of our deals yet, but maybe down the road that will be something that will be enticing for some of our investors as well. But I'm glad you mentioned that. Another interesting piece with triple net. I always thought of as triple net were like 5 to 10 year holds pretty much at a minimum. But when you start to hear about how you can adjust the lease, there's a lot of opportunity to potentially make quite a bit of money in a short period of time. But at that time, you do have some capital gains, so you just got to figure it out. Hey, is the tax bill going to be worth the gain? And if it is, run the play.
Well, then you can also look at 1031 exchanges, and there's different ways to try to avoid that, kick the can down the road, and continue to build some serious wealth.
Yeah, good stuff. What else would be something that our investors should know about triple net that I'm not bringing up that you would say, hey, if I was looking into investing in these deals passively, this is what I would really want to know.
Triple net, again, I don't want to call it a boring game, but it is just really, and the stuff we're looking at is really steady Eddie plays. You're not going to get a lot of market fluctuation in it. We get our debt set right away. We've got our lease in place. And most deals that I know you and Mike and myself are looking at together are 15 to 20 year leases. And, our game plan is to hold them for, could be anywhere from 3 to 10 years because they're creating consistent cash flows and have great annual increases. So you're going to see always gaining or, multiplying cash flow. But more than anything, they're just solid deals. We're going to take a ton of depreciation on them. None of us love to pay taxes if we don't have to, and we would love to minimize that and just continue to keep building wealth.
Yeah. And the 3 to 10 year hold would be a potential refinance, and let's pull some equity and put in a new debt level so that we can have our cash out and own the deal with less money in the deal. So I'm excited, Kyle, to be bringing out. Looks like our first deal will likely be coming out here in the next couple weeks, assuming a couple small things come to fruition, which is super exciting for us. And I'm excited to be working with you. I think the biggest piece, again, going back to anything in investing with real estate specifically, is who is the team and what's their track record and what's the synergy like. Because at the end of the day, we've seen it time and time again. The only thing that attracts capital is the deal. It's really all we're doing is saying, hey, here's what we're buying and here's why. Do you agree with our underwriting? Do you agree with our projections? And if you are, great, let's roll. So excited about the future, Kyle, and appreciate you coming on. Any last words of wisdom here for our listeners?
No, I appreciate you having me, and I'm also excited for the synergy. Like you've mentioned already, we've done 3 multifamily deals together, and knock on wood, we've been very successful with them. But to introduce you guys to a new asset class that I think can be a great one for a lot of your investors who have some different goals, I think is going to be super exciting. And just learning something new is always exciting, but also just be able to not feel like you're maybe stuck in one sector. So if we can use our skill sets to try to master multiple sectors and get investors exactly what they're looking for, I think it's going to be a great all-around deal for everyone.
Yeah, if you guys want to invest with us, we have to have a pre-existing relationship with you. We do 506B raises. So if you don't know us, get to know us, reach out to us. Our website, www.granitetowersequitygroup.com/contact us. Reach out, get on a call, help us get to know what you're looking to do, what you're looking to create. We'll get you on our database, and you can start to see future deals from us. And we appreciate you listening. As always, thank you again, Kyle, for coming on. And we'll be back next week with another episode of Keeping It Real Estate.
Appreciate it. Thanks, Dan.